Today, we're going to use 3 companies' earnings conference calls and presentations to piece together at least part of the story on the broad housing market, the sweet spot where the rent versus own conundrum lies. And these numbers illustrate the situation nicely. If we can use PulteGroup to gauge home builder and subsequently home buyer demand, things have slowed. However, Ryan Marshall, the president and CEO, has pointed out that it's a regional issue which should impact PulteGroup. We can also understand why Essex Property and Equity Residential both increased full-year guidance. They rent luxury apartments in high-end markets, including the tech hubs of Northern and Southern California and the Pacific Northwest. In these places, high earners might not be willing or able to buy a home due to high interest rates or the need for a hefty down payment. However, they do have the cash to drop on outsized rents while they sit on the sidelines. As a result, revenue is up across the board for Essex County in these frothy markets. And that's pretty much the same story for Equity Residential, which owns and operates luxury apartment buildings in the same markets as Essex, plus New York, Boston, the District of Columbia, and Denver. The bottom line is this: if you plan to play housing via the stock market, you might be best off focusing on markets with high earners not quite able to afford home ownership, but more than able to drop a couple to a few $1,000s a month on rent. It's these, in some cases, paycheck-to-paycheck millennials who make big money to live well each month, but don't quite have enough socked away to, say, drop 5 or 6 figures for a down payment on a $1 million-plus home. These people represent Essex and Equity's target market.